They dumped silver. In hours, billions vanished from the paper market, yet the metal itself didn't move. Imagine watching the screen and seeing the price collapse by over 20%, while every mint, dealer, and vault on the planet suddenly becomes unreachable. You try to buy, and it's gone. Out of stock, suspended, allocated, nowhere to be found. And yet, the paper market is screaming crash. Does that make sense to you? Because it doesn't to me. Not anymore. Think about it for a second. In every market you've ever known, when prices fall, supply floods in, sellers appear, products become available, and the panic usually passes. But silver? No. The price crashes, and suddenly the physical world is disappearing in front of your eyes. The shelves are empty, and every reputable mint on the planet is pausing, limiting, or outright suspending sales. That is not a normal market. That is a system under pressure, so tight, so fragile, that every keystroke in New York is dictating what people in Shanghai, Dubai, and Mumbai can actually hold in their hands. Let me break this down for you, because if you don't understand it now, you will be a victim of it. There are two silver markets, not one. Two completely different realities. The first is the paper market. Futures contracts, ETFs, digital promises of silver. They trade billions every single day. Hedge funds, banks, and institutions manipulate it, moving numbers around as if it's a video game. Most of these contracts will never result in physical delivery. The metal is virtual. It's a promise, and promises can be broken. The second market is the physical market. This is where the truth lives. Coins, bars, bullion in vaults around the world. Here, scarcity cannot be faked. If it's gone, it's gone. And right now it is disappearing faster than any of us can track. So let's look at the evidence. The Perth Mint in Australia, one of the largest and most respected in the world, paused wholesale orders. Not because demand was falling, but because they couldn't keep up. A backlog of orders had built up while the paper market was still trading at 117 per ounce. Think about that. Even before the crash, the mints were at breaking point. Then the price falls to $95. What do you think happens next? Every institutional and private buyer who could get their hands on physical silver suddenly accelerates orders. The crash doesn't decrease demand, it amplifies it. And the United States Mint suspended all sales. Products temporarily unavailable, American Silver Eagles delayed, subscriptions sold out, and when they do come back, the price has jumped nearly 90% overnight. You see the pattern emerging. While the paper market screams sell, the physical market is being drained quietly, relentlessly. India? Dealers defaulting on deliveries. People paying for silver and not receiving it. The Royal Mint in Britain? Out of stock. Not just coins, even standard bars. Costco? Implementing purchase limits. Yes, a retail chain limiting bulk silver sales. And none of this is coincidental. This is a systemic shortage, a stress test on the global silver infrastructure. Now, let's zoom into China, because this is where the story takes a twist. Shanghai Futures Exchange vaults held roughly 455 metric tons this morning. By the close of one trading day, nearly 27 tons were removed. That's 870,000 ounces gone in a single day. If this pace continues, the vaults could be critically low in weeks, not months. And remember, China has classified silver as a strategic asset, controlling exports. They are hoarding metal while the paper price collapses in New York. This is a clear divergence between perception and reality. One market is a game, the other is survival. Here's where most people get it wrong. Nearly all the dumping this week occurred during US market hours. Not in Shanghai, not in London, in New York. When US traders open, prices fall. When New York closes, the metal stabilizes. Sometimes it even rises in Asia. This is not random, this is coordinated. The West is selling paper, the East is buying physical. And while the West drives the price down on a screen, the East takes possession. The disconnect has never been this extreme. Lease rates tell the same story. Normally, borrowing silver costs a fraction of a percent. Today, reports show rates as high as 39%. To borrow physical silver, holders demand enormous premiums. That is a panic signal. It is not fear over price. It is scarcity manifesting in the real world. Physical silver is not just rare, it is nearly unavailable. Now pause for a moment. Let this sink in. The paper market is crashing. The physical market is emptying. Who do you think actually understands silver's true value? Who is positioned to benefit from this disparity? You're watching a game where the chips are digital, but the prize is tangible and only a few are collecting it. Let's put this in perspective. Since 2021, global silver demand has exceeded supply every single year. Industrial applications, solar panels, electronics, EVs, jewelry, investment coins, the drain has outpaced the faucet. Over 5 years, the cumulative deficit exceeds 800 million ounces. The bathtub of silver that once buffered supply shocks is nearly dry. Now, a single surge in demand or panic in the paper market exposes the fragility of the system. And that is exactly what we're seeing today. Imagine if you had a warehouse stocked with silver bars. Every week, hundreds of tons leave, but new supply only trickles in. You can't manufacture silver. You can't create it digitally. Yet the paper market tries to convince the world the asset is worth $95. Meanwhile, buyers across Asia are paying 30%, 40%, even 60% above that price to get the real metal. Lower paper prices are actually accelerating the scarcity. The crash is paradoxically creating higher demand in the physical market. Historical parallels add even more weight to this. In 1979 and 1980, the Hunt brothers attempted to corner silver. The paper price and physical availability diverged dramatically. Dealers ran out of inventory. People couldn't buy silver even as prices surged. The lesson: the paper price is only a number. The real-world supply determines what you can hold in your hands. The mechanics are different today, but the fundamental dynamic is the same. When physical demand overwhelms supply, the market has no choice but to adjust. Now, here's the critical insight most people miss. The crash you see on the screen isn't random. It is strategic. End of month, end of week, options expiry. These are not coincidences. The price is deliberately compressed to shake out weak hands, to create fear. This is how wealth is transferred. From reactive, panicked traders to patient accumulators who understand the mechanics. Your fear is their opportunity. And if you don't recognize it, you will sell your physical metal at the bottom, handing it to someone who sees its real value. Here's another angle you probably haven't considered. Physical premiums are regional, and they are exploding. Japan 60%, Dubai 40%, the US Mint repricing nearly 90%. The paper market says $95. The world says much more. If you can get physical silver at reasonable premiums today, consider yourself lucky. That inventory will not last. And when it disappears, the paper market will no longer matter. Eventually, reality always wins. So what should you do? First, do not panic. Panic is exactly what this market anticipates. The systems are designed to exploit fear. If you already own physical silver, hold it. If you are in paper, ETFs, or futures contracts, ask yourself, could your counterparty deliver if physical demand surged tomorrow? The answer is probably no. You own a promise, not the metal. And promises can break. And here is a paradox that is hard to grasp. The lower the paper price falls, the faster physical silver disappears. Lower price, higher demand, faster depletion. This is a market anomaly caused by systemic stress, not by poor investing decisions. If you understand this, you are already ahead. You see the market for what it really is, not what the screens pretend it is. Now, before we continue, I want you to consider this. Every major mint and dealer on the planet is under stress at the same time. Perth, US, Royal Mint, India, Costco, lease rates are spiking, Shanghai vaults are draining, paper markets are crashing. If this doesn't signal a fundamental imbalance, I don't know what does, and yet mainstream media won't report it. They focus on headlines. Silver crashes 26. They ignore the systemic reality. The world is running out of metal. Here's a scenario to think about. Imagine if tomorrow everyone demanded physical delivery from ETFs and futures. Could the system deliver? No, not even close. That is the disconnect you are witnessing. One side is playing a video game. The other is taking home the prize. And that is the story nobody is talking about. Let's zoom in on timing again. Big moves often happen on Fridays. Options expire, futures settle, traders square positions. January 30th, 2026, last trading day of the month, the perfect storm to orchestrate a crash. The timing wasn't random, it was calculated. And if you think it's coincidence that silver has been in a deficit for 5 consecutive years, that too is part of the larger narrative, structural stress meeting market manipulation. Now let's step back and look at the broader economic implications. Physical silver scarcity is not just about the metal itself, it signals deeper market dysfunction. When essential commodities, especially those tied to industrial and strategic applications, face structural shortages, it exposes vulnerabilities in the global supply chain, leverage systems, and the way paper markets interact with physical assets. Every move, every forced liquidation, every premium spike tells a story about systemic imbalance that could ripple across other asset classes. And here's the counterintuitive part that shocks most people. The paper market, as volatile and manipulative as it may appear, actually creates opportunities for those who understand the system. While prices crash digitally, the metal disappears physically. Smart investors who see beyond the screen can accumulate real assets at suppressed paper prices. The market looks weak, but in reality, the foundation is shifting beneath the surface. Let me ask you this. If you were in Shanghai or Dubai, would you wait for paper markets to stabilize? Or would you move fast to acquire the tangible asset that everyone else is chasing digitally? That's the divergence, the fundamental asymmetry in today's silver market. One side trades illusions. The other secures reality. And right now, reality is winning quietly, far from the screens everyone watches. Now that you understand what's happening, let's take it a step further. The disconnect between paper and physical is not just a curiosity, it is a window into a rigged system. Imagine a room where trillions of dollars in silver are being traded every day, but most of it doesn't exist. Digital numbers bouncing on screens, futures contracts that promise delivery, but delivery never comes. And yet, somewhere else, real silver is being taken off shelves, shipped into vaults and hoarded. One side is gambling, the other is securing reality, and the gap between them, it's widening faster than almost anyone realizes. Think about the implications. If physical silver continues to disappear while paper prices stay depressed, we are approaching a tipping point. The paper market may continue to manipulate, to crash, to create panic, but eventually, scarcity wins. When that happens, the price will adjust violently to reflect reality, and it won't be gradual. You will see moves that dwarf anything in recent memory because there simply isn't enough metal to meet the latent demand. Let's examine what happened this week. The US market opened and billions of paper silver were dumped. Red candles, margin calls, panic selling. The screens told one story: silver is worthless. But when the New York floor closed, silver stabilized in Shanghai. Vault withdrawals continued, physical premiums climbed, and the metal simply vanished from the system. The more the paper market screamed, the more real-world scarcity accelerated. That is not coincidence. That is leverage. That is control. And it has a lesson in why understanding who holds reality matters more than who controls the screen price. Now, here's a question I want you to really think about. If you owned physical silver, would you sell it today because the screen says $95? Or would you recognize that the screen is lying? That the real market, the tangible, measurable, and increasingly scarce metal, is signaling something completely different? Because the truth is, the paper price is noise. The noise is loud. The noise is terrifying. But the noise is irrelevant if you know how to interpret the signals underneath it. Let's go even deeper. Lease rates have exploded. Borrowing silver now costs massive premiums. Why? Because physical metal is scarce. Holders know that every ounce lent out could be recalled or could appreciate dramatically. This is structural stress. And when something is structurally stressed, it's not a matter of if it will correct. It is a matter of when and how violently. The system cannot maintain a facade forever. Eventually, the discrepancy between digital promises and real assets forces a reckoning. Imagine, just for a moment, you're an investor in 2026 watching this unfold. You're following the news, seeing silver crash on your app, reading headlines about volatility. You might think, now is the time to sell before it goes lower. But what you don't see is Asia accumulating physical silver at every opportunity. China, India, Japan, the UAE, buyers who understand scarcity are quietly taking possession, withdrawing metal from vaults and creating a global shortage that will soon be impossible to ignore. One side is playing the long game, the other is panicking on the surface. Who do you think will come out ahead? And this is why historical parallels matter. The 1979-1980 silver squeeze was in T just a blip. It was a demonstration of how paper markets can be manipulated, how physical demand can overwhelm supply, and how systemic stress can create extraordinary wealth for those positioned correctly. Today's dynamics are different. Circuit breakers exist, ETFs dominate, paper contracts are more regulated, but the fundamental imbalance remains. When physical scarcity confronts digital leverage, reality wins eventually, and it wins hard. Here's another layer most people miss: the geopolitical dimension. China has classified silver as a strategic national security asset. That's not casual. That's not marketing. That's a statement that silver is critical for industrial applications, defense, and emerging technologies. If a nation like China is hoarding while the US market is dumping paper, what does that tell you about where the real value is going? The narrative isn't about price, it's about possession, physical control, real ownership. And yet, mainstream media frames this as market volatility. Silver crashes $26 in hours. That's the story they tell. But if you dig beneath the surface, the real story is being written in warehouses, vaults, and secure transport vehicles. Every ounce that leaves Shanghai or Mumbai and enters private storage is a signal. Every mint suspension, every defaulted delivery, every allocation notice is a clue. The headlines will mislead you, but the facts don't lie. Now, let's connect this directly to your investments. If you are holding ETFs or paper contracts, you are betting on the system delivering metal that may not exist. If a rush for physical delivery happened tomorrow, many counterparties would fail. That is the structural risk most investors ignore. And if you hold physical silver, you are sitting on the one asset that is actually scarce, actually tangible, and actually appreciating under stress. That is why understanding the difference is not optional. It's survival. Here's a thought experiment. Imagine the paper price collapses further to $85. Most people panic and sell. Meanwhile, physical silver is disappearing faster than ever. The very panic they create accelerates scarcity. The lower the paper price goes, the harder it becomes to find real silver at any price. That's counterintuitive, and that's exactly why understanding the mechanics gives you a massive advantage. Midway through, let me pause and ask you, are you seeing the pattern? The West dumps paper, the East accumulates metal. The system is rigged, but not in the way most people think. It's rigged in favor of those who understand scarcity, timing, and control. This is not luck. This is structural leverage, and the opportunity lies in recognizing it before it becomes obvious. And here's the part that will surprise many. Physical premiums aren't just regional, they're signals. Japan, 60%, Dubai, 40%, the US Mint repricing nearly 90%. These are not anomalies. They are indicators that supply is being hoarded, rationed, and redistributed. The world's most liquid accessible sources are stressed, and that stress will ripple across other markets, industrial metals, precious metals, even energy commodities. Scarcity has a way of cascading. Now imagine you're an investor looking at your portfolio, stocks, bonds, crypto, ETFs. You've seen volatility across the board. But here in silver, the story is different. The digital market screams weakness. The physical market screams scarcity. This divergence is rare. This divergence is where wealth can be preserved and accumulated if you understand it. It is not obvious, it is not reported, and it is happening right now. Let's talk timing. The crash you just witnessed occurred on the last trading day of the month, end of week, options expiry, futures settlements. Big institutional positions were squared. The move wasn't random. It was engineered to shake out weak hands, to create fear, and to consolidate positions. Those who panicked sold their digital contracts. Those who understood the structural scarcity quietly acquired real metal. Timing is not coincidence. It's leverage. And history repeats in ways most people don't notice. Silver has been in deficit for 5 consecutive years. Every year demand exceeded supply. Industrial investment, jewelry. The bathtub of metal is draining. And now, mints are rationing, vaults are emptying, lease rates are spiking. This isn't volatility, it's structural reality asserting itself. And the longer the paper market suppresses price, the more severe the eventual adjustment will be. Here's another question. If you could hold physical silver right now, would you? Or would you wait for the price to recover digitally? Because the lower paper prices go, the faster the physical metal disappears. And once it is gone, no digital paper will substitute for it. That is the paradox that most investors fail to see. The crash creates demand. The demand accelerates scarcity. Scarcity eventually dictates the real price. Now, I want you to think bigger. This isn't just a silver story. This is a story about how global markets operate under stress, about leverage, scarcity, and control, about which side of the trade you're on. Are you trading illusions on a screen, or are you securing reality? The implications reach far beyond silver. Every asset backed by physical delivery, every strategic commodity, is subject to the same dynamic. Midway here, I want to hear from you. Drop a comment if you see the divergence between paper and physical like I do. Have you witnessed scarcity in real time? Or are you still watching numbers on a screen, wondering why the metal isn't available? I read every comment. These discussions often reveal insights that even major analysts miss. Now, let's connect this to action. If you hold physical silver, do not sell because of paper price movements. That is exactly what the system expects you to do. Hold, accumulate. Recognize the scarcity. Recognize that the East is taking delivery while the West panics digitally. If you hold paper, ask yourself, could your counterparty deliver if demand surged? If not, treat that position as a promise, not an asset. And here's the critical insight for investors watching this unfold. The paper price is manipulated. It is volatile. It creates panic. It creates opportunity. But it does not reflect reality. Reality is scarcity, delivery, control. And as long as you focus on reality, you will understand value better than most traders in New York or London. Now, before we close, let me leave you with the ultimate paradox. The lower the paper price crashes, the faster the physical metal disappears. Lower prices, more demand, faster depletion. That is counterintuitive, but it is the secret to understanding this market. It is a market built on scarcity, manipulation, and structural stress. And it is the rare moment where patient, informed investors can secure real value while others panic. Finally, if you followed this story to this point, subscribe and stay tuned. Because the real story of silver is just beginning. This is a systemic shift, and it's happening while most people are distracted by headlines. The crash is noise. The scarcity is signal. And if you position yourself correctly, you will understand wealth, timing, and control in a way few others will. Drop a comment now. Do you trust the paper price or the physical reality? Which side of the system are you on? I read every single comment, and the insights shared here shape the next episodes. Because this is not just a crash, this is a structural shift in global markets. And it is happening right now, in real time. Remember, the world dumped silver on screens, but the metal disappeared in reality, and those who understand which side holds the truth will not be fooled. The market may be rigged, but you don't have to be a victim. You have a choice. Stay with this story. The next moves in silver, the next ripple across global markets, will define wealth preservation for the decade. And when it happens, those who held, those who understood, will see the real value of physical assets, while the rest chase illusions on a screen.